My name is Mex and you're welcome to Mexonomics, and today we're discussing how the stock market works. So a lot of time I get the question from a lot of people, what is the stock market that I keep hearing about? Tell me, how does it work? How can I invest? How can I make money from it? How is it run? So the stock market is, simply put, is a platform where buyers and sellers trade publicly listed stocks. So I'm sure you're aware that most very large companies end up listing their shares on the stock market. When you buy a stock from the company, when you buy a stock or a share, whichever one you want to call it, it gives you part ownership of the business. So rather than be the really intelligent entrepreneur that can start up these companies that eventually end up being listed on the stock market, you too can be a part owner of those very successful businesses by simply buying a share in a company. A share gives you a claim on the earnings of that company. So as a part owner, when dividends are going to be distributed to the shareholders of that business, you would also be a beneficiary as a stockholder, as a shareholder of that company. So the stock market is a platform where all of those large companies trade their shares, and anybody who's interested in buying, investors can buy into that company or could sell that company. But it's not the same type of market that you're used to, where you can just walk in and say, oh, I want to buy this, and the product is served to you. Typically with this type of products or this type of assets, you can only get access to it through your broker. So stockbroker is the guy you want to call when you want to make a trade, because it's a highly regulated market. The stockbroker takes your order and helps you place that order in the market, and somebody else that you want to buy from agrees a price with you, and when that transaction happens, you become a shareholder and that person exits as a seller. So because prices are constantly moving all through the day, thousands of people are bidding to buy a share. Thousands of people are trying to sell their shares. That's why you see stock prices change 1,000 times a day, because constantly everybody is showing you what they are willing to buy the stock for, and the owners are saying, this is how much is the maximum I'm willing to take in order to sell my stock. So that interaction of prices on both sides continues to cause that price gyration that you see all day long in the stock market. That's why you can see stock prices go up and down. Again, what you need to know about the stock market is that stock prices give you an insight to what investors believe is happening in that company. High optimism in the future of that company means that the stock price will go up over time. High pessimism over the future of that company means that the stock price will decline. And where people are being overly pessimistic and saying that, oh, the future looks bleak for the company, or because of some strange reason, people are selling off the company. You know, people sell the company for different reasons. It doesn't necessarily need to be that the company is doing poorly is why people are selling. Sometimes it's that people just need cash and they need to sell some of the things that they own in order to create cash, and those things can force stock prices to fall. Pension funds, insurance companies that own these stocks may need cash to satisfy their own clients. So to generate that cash to pay out to their clients, they need to sell some things. So those are why prices could gyrate, not necessarily because the company is not doing well. So what you want to do as an investor is keep an eye on where are people overselling that they shouldn't, how far have those stock prices fallen, and those are the things that you need to buy and hold them for the long term. You bought it because it was falling. If it falls a little bit more, you shouldn't be worried. It's just an opportunity for you to buy some more, because you know that in the next 1 to 2 years, when there's more stability in the company, people have now understood that those things that they're really scared about doesn't really materialize. You will then see a very sharp rally in the stock. So lots of people that trade stocks try to say, oh, this is trading at 10 naira. Do you think it will get to 15 naira? Should I buy it now? That means I'm going to get a 50% return. That's a very risky way to trade stocks. What you want to do is not trade stock, but invest in them. What you should be doing is figure out what stocks are really worth 10 naira but are selling for 5 naira. Because if you buy those things that you believe they are worth 10 naira and selling for 5 naira, is that when it goes from 5 to 10, you are able to generate 100% return on those type of investments. And sometimes you may be lucky, those things could move from 5 to 10 within a very short period, 6-month period, 1 year period. Sometimes they could take as long as a 5-year period. What you need to do before you invest in this thing is ask yourself, is there a catalyst that is going to drive people to where the real value of the stock really lies, which is called the intrinsic value of the stock. So if you believe that the intrinsic value is 10, but it's currently trading at 5, do you think there's something significant that can occur that will act as a catalyst to drive the price of that stock closer to what is worth? Sometimes that catalyst could be that the company results comes out and is really great. Sometimes the catalyst could be there's a change in policy and people think that this company is going to really benefit from this change in policy. Sometimes it could even be a change in management, that the previous management weren't doing so great and then the new guys have come with this really brilliant strategy that's going to turn things around. There are several things that could act as a catalyst that drive things closer to what they are worth. Or it could just be that there's a sudden epiphany in the market and people suddenly say, oh, this stock looks oversold, let's all jump back into it. Maybe a top investor comes into the market and say, I believe that this stock has been oversold and I believe it's worth this much and I'm buying, and everybody follows his suit and just joins him and buys. Those things could all drive the stock prices back to the intrinsic value and you could get significant returns. So what you need to be doing is not buy things hoping that the prices go up. What you need to do is buy things knowing that the price of that thing compared to its intrinsic value means that that stock is selling at a discount to its value, and once that discount is closed up by the price rising to its intrinsic value, that's where your returns will be generated. That is how value investors have done it for years. Successful value investors like Warren Buffett, Ben Graham, Carl Icahn, Bill Ackman, all of those intelligent guys have done this for years, made a ton of cash investing in the market, and that's what you should be doing too. So if you need more information on the stock market, just take some time, do some research, do some education, learn about the market, and start buying stocks. Don't trade them, buy them, invest your funds in them, hold them for the long term, and I can assure you, you will make a killing in the market. And if you think that there are more questions that you want to ask that are unanswered in this video, you can just drop your comments below and we can address some of those questions in subsequent videos. If you love what you've heard today and you enjoyed this, please like and subscribe and follow me across all of my socials, and have a nice day, guys. See ya.